Today, we've got a special deep dive conversation with a couple of guests. Our normal crew is here, minus Sali Omaz, who's not with us today because he's at the International Energy Forum in Saudi Arabia, where he's been hearing the readout from OPEC, IEA, and others. So next time we'll get the readout from him on the discussions there. Here in London, we've got Will Hares and Patricio Alvarez. We've got Fernando Valle in New York. And the guest of honor is Adeline Diab. She heads our ESG research and thematic investing for EMEA and APAC. And we've also got Rob DeBuff, who's joined last minute. He's a senior ESG analyst based in New York City. And look, our regular listeners know we're not shy about talking about the so-called energy transition. We regularly touch on the E portion of ESG on this call, but it's a much broader concept than that. And frankly, ESG seems to constantly be in the headlines these days, and there appears to be a culture war that is brewing around the idea. Ron DeSantis, the governor of Florida, tweeted on Monday, I'm just going to make sure I get this right, ESG is a threat to the American economy and the individual freedoms that our country is built upon. It is dead on arrival in Florida. So I want to come to you first, Adeline. How would you define ESG, and why is the concept appearing to be so polarizing in your view?
Hi, everyone. Thank you. So I guess what I'd like to start today is more about what ESG is not. So just to have a same level of understanding, because there's often confusion. So ESG is not about values. It's not about good or bad. It's not about climate per se in terms of climate impact and having a positive impact in the world. It is not a social score. It is not about reducing an investment universe either. So what it is, ESG is supposed to it's about additional data that are available today and much better than they used to be to help investors make better informed investment decisions, to have a better understanding of an operational efficiencies of companies, and to be able to identify risks to, again, profitability and companies that are not preparing perhaps to some risks that used to be externalities that nobody cared about, but today there are liabilities that need to be internalized and taken into account by investors and companies.
And so just to follow up a little bit on that, I think I've always sort of had the concept that the jury's out a little bit on whether those factors, that additional data, really help to improve the investment return. And so what's your latest read? Are ESG investments potentially going to offer a better return in the long run, or are ESG investors sort of optimizing around a different investment paradigm?
So I guess there are two parts to my answer here. The first one is that, again, having such data, and again, for investors and companies that do not ignore it. So being able to not only have it, but be able to manage it, control it, and measure it, really help a company better manage its companies on the E, but also on the S and on the G, on the accounting side, etc. So it's about, so such data will help have a better understanding of a company and hence help manage it better. And for companies that perform better on these criteria, which complement fundamental analysis, well, we have a insight that others do not if they ignore it. And hence, for example, many years ago, between a BP and a Rio Tinto, which are two mining companies, both of them are listed in Australia and in the UK, are diversified miners, performed kind of on the same path because they were both exposed to China growth or whatever. Okay, they were kind of, if we were invested in one of these stocks, it was because we believed in the mining sector going up. But if we used ESG to cherry pick one of them, one was doing better than the other, and I won't say here, but then there was better insight because of better, less fatalities, less carbon emission per ore extracted, and better governance. Three factors that one company had, the other did not. So one company was much more resilient to downside risk and was just much stronger, yet the same upside. So I think it helps secure future-proof returns when this is a complement to a financial analysis. And my second part of my answer, I would say, based on our analysis in the team, is that yeah, we have quant analysts in the team, and we do a lot of deep analysis, and we have several reports showing how some factors, whether it's carbon, whether it's more diversity, whether it's CO compensation, is linked to better returns. I'll see if Rob wants to add anything, but I guess that would be my answer.
Yeah, I mean, I'd agree with that. I mean, some more concrete examples. So by way of background, you know, I used to be an oil and gas analyst until I started covering ESG. But, you know, again, I don't even know if it complements fundamental analysis so much as, you know, it is a part of fundamental analysis. I mean, thinking back, like when I used to do you know, looking at IRRs or NPVs of you know, well investments, you know, you look at things that like netbacks and lifting costs. So like, you know, if you're you know, if your analysis tells you that, you know, you're operating in a region that's going to implement a carbon tax, for example, or let's say, you know, water availability is less, or even the labor market's tighter. I mean, these are all things that need to be embedded in your investment decision when you're looking at wellhead economics. So you know, it's not, you know, you're not looking at how many trees are the landmen hugging when they look for oil wells, right? You're looking at, you know, things that actually have a material impact and on the business. And I think that's kind of, I mean, your point on is ESG going to do good or bad? I mean, it's ESG it's a discipline. It's not a one strategy that everyone does it the same way. It's, you know, trying to identify risks and opportunities for individual that are maybe material to a specific business that maybe isn't historically been on the balance sheet or income statement.
I love the vision, and for anyone who doesn't know, you know, BI, we cover about 2,000 companies, and increasingly there is an ESG primer that is affiliated with the company coverage, and those have been rolling out. You can find the great research that Adeline and Rob have been helping to conduct at BI ESG. And another company, and it's great, Rob, that you've got the background in oil, and there were a lot of headlines last week following BP's earnings that talked about their strategy to more slowly curb oil and gas production. And I want to come over to Will Hares, and we saw a lot of headlines talking about U-turn or this idea that BP is back into petroleum. Quickly just give us an overview of what happened and what your take is, and then I want to get the ESG team's take as well.
Yeah, thanks, Rob. So concurrent with BP's 4Q results last week, we saw a from the can you hear me? Sorry.
Go for it.
Sorry about that, a technical issue. Yeah, we saw a pretty material strategic shift from
Hey, Will, why don't you just come over here? We'll trade. We're gonna do something we've never done before. We're gonna just trade headsets to give Will and Ant a chance to speak. Here we go.
All right, thanks, Rob, bailing me out there. So we saw a pretty material strategic shift from BP's management team, whereby they, the headline of their announcement was slowing the decline of their oil and gas production to 2030. From 2 years ago, Bernard Looney's original strategy saw a 40% decline in oil and gas production volumes, which was a tectonic shift relative to their peers. They've slowed that to 25% out to 2030 now, and this is coming as a function of increased investment in oil and gas, roughly $1 billion more a year out to 2030. We are also seeing a deferral of divestment of legacy oil assets that they flagged as well. And alongside this, they are also decided to increase investment in their transition growth engines as well. But overall, from an ESG standpoint, I think it's a pretty clear testament to where ESG stands at the moment, at least within the energy space. We've seen the stock price for BP move up nearly 20% over the last week. And a lot of that can be attributed to their new strategy, in which they flag much higher returns from their oil and gas portfolio. They approve projects at a minimum 15% IRR. This compares to 4 to 6% unlevered returns on their renewable power projects. So I think it's clear where investors stand when you look at how the business is going to generate profits over the next 8 years. I'm going to hand it back now to Rob.
All right. Well, that was fun. Thank you, Will. So let's come back to you, Adeline. The question that comes to my mind with you on this, and we don't have to get into kind of how the specifics of the ESG scoring works within Bloomberg or other companies that do that kind of thing. But I think just like conceptually on the face of it, I'm curious to kind of how you read this idea of, well, you know, oil and gas companies, they produce fossil fuels, they have an emissions profile today, and is ESG about where they are today, about or more about where they're headed, and how do you balance the kind of sort of current footprint versus what the footprint might be in the future, when you kind of think about ESG or just any of these other metrics? You know, it's like, is it a snapshot in time, or is it about where they're headed?
Okay, so I guess, again, two parts to my answer, maybe three. So the first comment, I guess, and it's something we talked about with Rob yesterday. So, and there's also some news about Shell, and so looking at the sector. But I guess our view is that is just another confirmation that we are in an energy transition. So it's not going to happen overnight. We're not going all green, and it shouldn't be either. We spoke about this with you, Rob, so the other Rob Barnett, last week, and obviously we'll still need oil for the coming decade or so, right, for the energy needs of the planet. So yes, we want, it's an energy transition, and BP adapting, adjusting its announcement. Yeah, I mean, it's in terms of I guess ESG comes, maybe that might be negative for I guess on a pure or sound or seem negative, but actually it doesn't mean that they're not going to reach their net zero target. It shows, I mean, the European players are still also heavily investing in renewable energy. It is a transition, and I think it's about how they manage that in the short term, and then and moving forward. But I don't think it means that they are not taking this seriously anymore. So that is the first part to the answer. And I guess what an ESG, I guess, score or what an ESG data shows, I mean, the thing is, it is backwards looking because it's taking data from a year prior, right? So it is backwards looking. However, this is not just what ESG is. When we do an analysis, ESG data helps understand historical data and up to the point we have them, understand where the company is, and are things deteriorating or improving, or is there a signal of several deterioration where you have a peak of emissions all of a sudden and a peak of fatalities or whatever. But this is complemented by more understanding where the industry needs to go in the coming 5 to 10 years to remain competitive. The energy sector is going through an energy transition. The fashion industry is increasingly looking into, like other models related to slow fashion, second-hand marketplaces, new fabric or whatever. Like there is several industries in landscape are being transformed via the sustainability trends, and to remain competitive, companies need to invest in those to remain competitive in 5-10 years. And obviously all the luxury brands are investing, for example, in those new innovation. And I think it's the same thing for the energy industry. And you have maybe two ways here. You have European and US, and I think Rob would know better than me all of the details. But again, to shorten my answer at this point, I would say BP announcement is just a confirmation that it's an energy transition.
You're on.
Sorry, Rob. Yeah, I meant to say, we're coming over to you. Go for it.
Yeah, no problem. Yeah, I would concur. I mean, there tends to be this, you hear this talking point, at least here in the States, among centrist or even right politicians about how we need a all of the above solution to the energy transition. And even though there, some people dismiss that as greenwashing, it is true that, we need to think about it as a transition, particularly, they talk about the just transition. So and it's not just an environmental issue. It's, how do you continue to supply reliable power to areas in need, or how do you continue to fuel other businesses, whether it's agriculture or what have you. So I think, definitely having to balance the short-term and the long-term needs is definitely the trick, right? You can't just, shut in all wells today, and also, you can't expect oil production to grow at high rates forever either. So, trying to find that balance is critically important to the transition. I will add also, with BP's announcement, certainly some of their renewable power segments are kind of low return, where they're kind of pivoting away from, but they're other kind of lower carbon solutions like biogas and renewable fuels that BP, as well as some of the folks in the States, Chevron, Exxon, are also investing heavily in. And those tend to be solutions that are more kind of compatible with today's infrastructure. I mean, you talk a lot about renewable diesel as more of a drop-in fuel, as opposed to having to install electric EV charging stations everywhere. So, I mean, I think there's definitely room even in today's economics for investments in solutions like that.
Okay, so I want to pivot and bring Fernando Valle on. I just pulled up EQRV. I'm looking at the valuations for European oil majors versus the Exxons and Chevrons of this world, and despite the rally that Will just mentioned for BP, the European oil majors do trade at a pretty healthy discount to their American counterparts. How much of that do you think is because of ESG factors, or is it a multitude of things?
I will let Rob take this one.
You're on mute.
We're all struggling with the mute button today. Apologies. I think certainly it has something to do with ESG, and not necessarily the discipline per se, but just how it's been approached. For one, I think ultimately, these stocks are all dividend or distribution stocks. So the sustainability of that dividend and the amount of distributions is ultimately what dictates the valuation for the companies. And there's no question, and we saw it in 2020, that BP and Shell had to cut their dividends while Exxon and Chevron continued. And we see it in the distributions now in 2022. Exxon and Chevron again dwarfed BP and Shell on that front. even though obviously the increase is much greater for BP and Shell. That has a lot to do with how their investments have fared. And even from the beginning, as Will was alluding to, the change 2 years ago when Bern Looney came into the CEO position at BP, they said the investments in green energies are lower return, and that's just a fact. And they probably are even lower because, as we talk about anecdotally, BP is not bidding so well on some of these projects, and the returns are just not there to support them. So when we see the inflection in oil prices that we saw in 2022, Exxon, for example, had the biggest shift in their invested capital and allow them to, repurchase $15 billion worth of shares and set a pretty healthy target of 35 billion through 2024. So I think in that front, that's a big part. And then there's just, again, as Rob mentioned, the factors of the future. And when you see Shell being sued in Holland for their carbon emissions versus Exxon and Chevron being sued in New York and that going nowhere about their carbon emissions, you have greater certainty on the return profile for the US versus the European. We often joke that, it used to be that Exxon had a discount rate for every single one of their projects that would be adjusted based on the jurisdiction. And you usually would expect emerging and developing markets to have a higher discount rate. And we joke that the highest discount rate is probably California now because of all the challenges there. And it shows. They sold their refinery, they sold their participation in Aera, which is their E&P in California. So it is probably their highest discount rate of the portfolio.
And I would note, I'm not super close to these statistics at the moment, but I do think California is either the highest or among the highest retail fuel prices in the US as well.
Yep.
Yeah. Okay. So I want to bring on Patricio now, just to sort of round out the conversation. Oil companies are complex. When you bring on these kind of ESG factors, how do they fit in? It's a sort of big debate. But I think utilities are a little different, and in many ways, they're the sort of front and center, leading the energy transition in many ways. Although, Patricio, I think you mentioned to me the other day that Enel is actually having to slow its energy transition capex here recently because of rising borrowing costs. So give us a breakdown of what's going on, and how do utilities fit into this conversation?
Sure. So I think I'll just hit Enel first. So Enel is the largest utility here in Europe. Well, it was previous to the energy crisis, at least in market value, but still by asset base and then by gigawatts installed, it is still the largest company in the world in terms of power generation and distribution. So what happened with the company was that because of the energy crisis and the various regulatory interventions posed into protecting customers, working capital needs soared during the commodity price volatility that saw gas prices more than 10x in September last year. So the company was now is set out to sell about 21 billion euros worth of assets from 2022 to 2024 in order to curb the largest debt pile amongst European utilities. And that's just in order to sort of keep things going in terms of growth spending. They reduced their scope or their 3-year spending plan by about 18%, which is significant. Explaining that this is the largest renewable, expansion company in Europe, at least. So this means that the company will exit many countries, especially in Latin America and Eastern Europe, to sort of refocus on its core Iberian markets and the Italian market. So what this shows is basically that it's just a status quo for European utilities, which are for now low return companies with relatively high leverage. These are companies that have been investing in the energy transition, in energy transition related opportunities, both in networks and renewable capacity. And as Will mentioned, these are lower return assets. If you compare them to other sort of thermal power assets, when power prices are high, you can sort of capture those margins. Renewables still offer I'd say a more stable return profile, given that they're mostly contracted in the long run. But it in those case just goes to show that these companies are subject to these low return sort of profile, and also a high leverage profile as well. And then jumping on to the second part of the question, which is just utilities' role as energy transition barometers, I would call them, as because we've seen already some of these companies actually fully transform from previously being oil and gas companies into full-fledged utilities, such is the case with Ørsted, which used to be a state-owned oil and gas company, and now is the largest offshore wind installer in the world. So that goes to show that favorable policy is needed. Economic incentives have to be sort of artificially, I'd say, or pushed by lawmakers in order to make the economics work. And I think it's also interesting to see that the U.S. Is sort of has surprised, I think, European lawmakers by passing the Inflation Reduction Act with many of the CEOs amongst our European utilities flagging that the EU should perhaps follow a similar path that gives that extra regulatory visibility. Whilst here in Europe, we're still stuck with new clawback taxes. They're aiming to reform the power market now because of the energy crisis. So I think what it shows is that utilities need clarity, and they also need the financial backing that comes with debt, basically.
These calls always, we always run a little over, so hopefully Adeline and Rob, you can stay with us for a few additional minutes past the half-hour mark, because there are a few more questions. We'll save a fun one to close on, but I wanted to come around on this idea that maybe is apparent here. So even before you take into account ESG factors, the calculus between thinking about a utility investment or an oil company investment is complicated, right? The return profiles look different, all of these kinds of things. And when you think about layering on ESG, one of the things that I've sort of always had in the back of my mind is that if you look at the ESG profile of an oil company, it's maybe not super comparable to the ESG profile of a utility. And so how do you think ESG comes into like a cross-sector comparison? And the reason that I really am trying to get at this is because I do think that the utilities are ahead of many of the other sort of energy type companies on this question. And so how do you think that should factor in? Adeline, we'll come to you first.
So to be honest, to have valuing company have different nuances and factors. When different sectors, you look at different things, and it's the same thing for ESG. So you would not look at the same issues for an oil company, for a utility, for a fashion company, or for a beverage company. So that's why at Bloomberg anyway, what we do, and having been in the market in the past, and I think it's the best way to do it. It's sectors. It's not even sector, i.e. the energy sector. It's a subsector specific approach to really identify at a detailed level what an oil and gas, what are the oil and gas risks that are specific to that sector, that sub-industry, versus a utility versus other sector. And that's very important. So we have a very subsector specific approach, and that's key to compare companies. And that's why you will see maybe, as you mentioned once, Rob Barnett, that a Vestas and an Exxon may not have the same score. How come? It's because you compare them to their peers. So yeah, amongst wind players, what are the key issues and how Vestas is faring relative, what matters to that type of company and how it is scoring relative to its peer group versus an Exxon and its peer group. And that's a reality. Now, an investor can decide to add another layer to decide how they rate industries and which industries matter to them. But in general, many investors try to replicate an index. And so it's you just replicate the weight of the index and you underweight companies. And so it's a sector specific approach, and hence you can leverage the sectors to cherry pick within that subsector how you want to underweight, overweight to replicate an index. So that would be my answer. I will let Rob chime in if there is more.
Yeah, no, I would concur that it's this isn't really an ESG specific question. This is a asset allocation or portfolio construction question, and that how much tracking error do you want? Just like when you see a diversified mutual fund, I don't think they're looking at, say, Apple versus GM versus 3M. Like, they're not comparing the investment merits. They're just trying to, looking to get sector neutral, or maybe they'll have they'll lean a certain way. And there are obviously sector specific funds. It's the same in ESG, right? You're looking at, who are the best in class on ESG metrics, industry specific ESG metrics within the industry silo, and then kind of you may want to take a fundamental view of maybe we'll overweight tech or we'll overweight dividends or things like that, but it's really just another overlay. I mean, I think kind of the classic example of this was Tesla. You saw a few months ago, Elon Musk tweeted that ESG is a scam because Tesla was kicked out of an index, but Exxon was added. It wasn't that someone looked at Exxon versus Tesla and said, oh, Exxon is better at ESG has better ESG scores than Tesla. It's just when they're balancing taking a sector neutral approach, they're looking at oil companies. Exxon has maybe moved up on ESG relative to other integrated oil and gas peers, whereas Tesla may have moved down, not necessarily because of their impact, but because of, say, social or governance risks that may or may not have played out over the last 6 months or year or so. So again, it really is, it's just part of the portfolio allocation process. It's not picking one stock and one stock only to include in your portfolio and put 100% weighting in there.
Now, I love your answer, and you stole the thunder. This is where I wanted to end, so it's a perfect segue. And I want to do a quick round robin on the idea that you just brought up. And so, look, you've already said it. Some notable ESG funds and indices include Exxon Mobil, while some of them also exclude Tesla. And so the question that I think it would just be twofold. And we if you want to take a pass because you haven't thought about it deeply enough, that's okay. But I'd love to just get views from around the room here on is Exxon Mobil capable of being an ESG pick, and is Tesla capable of being an ESG pick, and how do you compare the two? Fernando, I know you probably have a strong view on this, given you cover Exxon, so we're going to come to you first.
Sure. I think yes. I think for one, S and G have to have more weight than just E, right? I think it's easy to measure E, so we go to E all the time, but S and G also have a significant portion. I think for oil companies, a lot of the S's, you have to provide affordable energy to the world so that we can improve the standard of living across the world. We like to talk about Norway and Sweden, which is tiny little countries that are easy for us to clean up. But you look at India, you look at China, you look at Brazil, where I'm from, and most people live at a fraction of the energy intensity that we lead our lives, and they need to improve their standard of living. And so the S is a big part of that. Doing that in a sustainable way is, I think, probably weighs into the S as well. And then the G, and certainly versus several other companies, not to name any electric vehicle manufacturers or otherwise, the integrated majors have gone through a lot of governance pressure already. They had to realign their pay periods, and there is still some room to grow for sure, especially on board diversity and other factors. But certainly there is room where we can see an Exxon Mobil being a much better player than others, because they have the pressure now, and they are making those improvements.
Fantastic. Patricio, we'll come to you next.
So yeah, I think that borders a little bit outside of my my comfort zone. I mean, are we referring to the same two companies? So I guess switching a little bit towards my sector, maybe not so company specific. I think if we're considering, yeah, we value the ESG substance of a company, or the metrics or the quality just on disclosure. Yeah, I mean, a lot of companies can outperform others, and also depends, I think, of how you qualify their plans and their track record, especially on the E side, right? Like, if I were to take an example of companies that in their present is not great. So, for example, in terms of E metrics, environmental metrics, for example, RWE is a company that is still heavily, exposed to coal and lignite, but at the same time is one of it's the company that plans to build the most wind and solar over the next 7 years in Germany, and is going to spearhead their energy transition. So on that sense, I think, yeah, it's really hard to sort of pick apart without without disqualifying based on the actual strategy of the company. So that's my sort of convoluted reply, but I guess it depends on what you're assessing.
Okay, Will Harris, let's come over to you. Hopefully you got a better mic situation figured out now. Generally, oil company versus a EV manufacturer as ESG picks.
Yeah, I mean, I think the question was, is Exxon capable of being an ESG leader? And sure, it's capable. Is it capable? Yes, but it's not against its European peers, which have net zero emissions.
All right. Will, you were not meant to speak to us today, so apologies. Okay, so we're going to continue to work around the discussion here. We'll make sure we get your answer in the future. We'll give you a mulligan next time. Adeline, we're coming over to you. Tesla, Exxon as ESG picks. What do you make of the debate?
Two parts to my answer again. So I guess, I mean, again, coming back to what Rob was saying, from a sector-specific approach in their own respective subsectors, Tesla may or may not lead their peer group because of social and governance issues, which matter and weigh on that company, unfortunately. And equally, Exxon in its peer group may have improved over the past few years, with engine number one coming or helping improve the board, in my opinion, and yet Exxon, standing the course of their strategy. But ESG investors also recognize improvement. So yes, Exxon, it's in its own right, relative to maybe US peers, might lead that peer group, and maybe relative globally as well. If it's relative to European players, it could still be in the leading pack. So it depends again. So it's really sector specific. And what is the strategy of the investor? Is it to replicate an index? Then obviously Exxon might well be, because they improved, and because of the relative peer group, which maybe there are much more like worse players than them, whilst Tesla, it's an industry where maybe players are having more advanced on ESG, despite and have more rounded social and governance approach, which weigh a lot on that stock, and hence Tesla may not make it, and may score lower. So absolutely. So that would be the first thing. But if the fund of the investor is to look at, isn't it a green fund, where you cherry pick stocks not based on an index, but okay, which companies are gonna be part of the solution and the world in 2030, as if transforming the world. I mean, Exxon is definitely a very important part of the players globally, but Tesla, despite the social and governance issue, is definitely a frontier kind of company, you know, with a visionary CEO. It's not just about EVs. And yes, Tesla in that case would definitely, in my mind, make the cut or could make the cut because that's you're investing with a different lens. That's my view.
Fantastic. Rob, you already kind of gave a quick comment on this, but anything to add after hearing the discussion?
No, I mean, I'll give my diplomatic answer that every investor has their own risk tolerance and it depends. But yeah, no, I think definitely they could. And, you know, Fernando makes a good point about, you know, even though kind of, especially on your side of the pond, E and particularly climate gets a lot of the headlines, there's still other areas, whether it's worker safety. You know, there's an interesting article today on Suncor and how they're being targeted by activists for their horrible safety track record, by Elliot Paul Singer, who is, you know, kind of the opposite of the woke. You know, he's funding the anti-woke guys. So clearly, you can't just say this is woke capital or whatever they want to call it. There are issues that need to be monitored on the S&G side. You know, I would say definitely, you know, innovation, I think, is a huge role to play. I mean, Tesla got to be where it is because of innovation. Now, you know, Exxon is looking at, you know, more low carbon solution, whether it's carbon capture, whether it's some of the other kind of alternatives or other ways to supply the world with energy. I think there's definitely opportunity for that, and also continue to manage their you know, their oil and gas reserves in a responsible way. I mean, you hear a lot of talk about divestment and maybe divestment selling, you know, having someone who's a responsible operator selling off their entire oil and gas portfolio to maybe someone who's not as responsible as an investor. Maybe that makes the particular stock look on paper more ESG, but it's not doing anything to help the planet. So these are all things that need to be considered. So I think any company can be ESG if it's managed properly, and that's at the end of the day what the bottom line is you know, are you managing the risks and opportunities properly? And you know, any company can be that. Doesn't mean they all will, but it's possible for anyone, even Exxon.
Okay, I love this discussion. It has been super fascinating. I'm just looking right now, and we cover about 2,000 companies from an equity perspective. And for about half those companies, it looks like at this point we have live ESG primers. So make sure to check that out. You want to go more in depth, look at some of the scores, see how companies you know, stack up in that relative ranking within their sector. It's something that you are very capable of doing on the Bloomberg terminal. We're all easily found, so you definitely shoot us an IB if you have follow-up questions. And lastly, I would just say, you know, if you're a regular listener and you're not in our BI client chat, please reach out. We're happy to add you. There's a lot of great discussion about energy in general, including things like ESG. So make sure you're part of that discussion, and we look forward to being in touch. Last comment or last bit of advertisement is we hold these conversations on the first and third Wednesday of every month, and we hope you become a regular listener and send us feedback or thoughts on other topics like ESG that we should make sure to have a thematic discussion on. Adeline, Rob, thank you so much for joining. I'm sure we will have you back sometime soon to talk about how this topic continues to evolve.
Thanks for having us.
Thank you. Bye.